It feels like technology is just everywhere, doesn't it? In our pockets, running businesses. I mean, software is this invisible engine powering so much, which makes it kind of surprising maybe to hear that this engine, the software industry itself, seems to have hit, well, a bit of a rough patch lately. It's actually underperforming the wider market quite significantly. Okay, let's unpack this. We've seen this noticeable pullback in software, and it feels a bit counterintuitive with all the positive tech news, especially around AI flying around. So today, we're taking a deep dive into the material you brought together to figure out why this is happening. We want to get beyond the headlines, uncover the real drivers and what it all means for tech and the economy.
Yeah, it's absolutely a crucial moment to analyze. For years, software was, well, the darling of the investment world. So this underperformance isn't just a minor blip. It's a pretty significant signal from the market. And our analysis shows it's not just one thing. It's more like a confluence of powerful forces, macroeconomic shifts, sector-specific stuff, and even company-level challenges. We've sort of pinpointed four main drivers here: a big market rotation, that ongoing valuation correction you mentioned, a really critical shift in IT budgets towards AI infrastructure, and then some, frankly, mixed earnings from the big players. We'll explore how these all interact, how they're creating this challenging environment, particularly for those growth-focused tech firms.
Right. And you might have heard whispers about this, maybe seen some headlines, but your sources really lay out the hard numbers. It quantifies just how much the sector has pulled back. We're not talking about a gentle dip here. Over the last, say, 30 days, these pure play software ETFs, they've seen some pretty notable drops, like the iShares Expanded Tech Software Sector ETF, IGV, that was down roughly 4.7% to 5.3%, and the SPDR S&P Software and Services ETF, XSW, that fell somewhere between 2.7% and 6.5%. Quite a range, but definitely down.
Definitely down, yes.
Now, here's where it gets really interesting, and like I said, maybe a bit counterintuitive. This isn't a broad tech wreck, not across the board. You contrast those software numbers sharply with the broader S&P 500 ETF, SPY. That actually gained over 1.5% in the same period.
Right.
And even the tech-heavy QQQ, the Invesco Trust, that saw a gain of nearly 2.4% in July.
Which is telling.
Exactly. That QQQ strength weighted towards those diversified megacaps, Microsoft, Apple, NVIDIA. It tells us something important. Investors are being discerning here. This isn't just selling off all tech. It's targeted.
Precisely. And beyond just the price movements, the capital flow data really backs this up strongly. We're seeing hard evidence of investors actively pulling money out of software positions. That IGV fund you mentioned, it saw about $1.85 billion in net outflows over the last month. That's substantial.
Wow, yeah.
And XSW saw over $7.5 million in net outflows too. Compare that to the QQQ, which had massive inflows over the year. So this pattern really signifies what we call a sophisticated rotation. Investors aren't just abandoning tech altogether.
Right.
They're reallocating. They're moving away from what they see as the riskier parts, the high beta, cyclically sensitive software, stocks that jump around more with the economy, and shifting towards perceived stability elsewhere. The market's making a calculated judgment here, moving away from companies really exposed to those high valuations and, crucially, interest rate sensitivity.
Okay, so if it's targeted, then the big question is why software specifically? Is this just about the broader economy, or is there something else going on? Let's zoom out to that macro picture first. You mentioned sensitivity. Software stocks, they're often called high-duration growth assets. That's basically jargon, meaning their value today is heavily tied to earnings expected way out in the future.
Years down the line, often.
Right. Which makes them super sensitive to interest rates and the economic outlook.
Yeah.
And your sources note the Fed's been keeping policy tight, holding rates steady in July 2025. But Chair Powell's Jackson Hole speech kind of opened the door, didn't it, for a potential September rate cut. Markets seem to think it's highly likely, almost 89% probability.
Yeah, and this raises a fascinating paradox, actually.
Right.
If lower rates are usually considered good for growth stocks because they make those future earnings more valuable in today's dollars, why are we seeing software pull back now just as cuts seem possible?
Good question.
Well, the counterintuitive answer seems to be why the Fed is considering cuts. It's not because inflation is totally beaten and the economy is booming. It's because of emerging signs of weakness. Things like the labor market softening, overall economic growth moderating.
So the reason for the potential cut is actually bearish news itself.
Exactly. That underlying economic fragility, that's precisely why enterprise customers, the big buyers of software, are getting more cautious, more deliberate with their spending, it creates this sort of uncertainty pause on new
You're
projects.
tightening their belts.
Right. And on top of that, inflation is still sticky, isn't it? July 2025 CPI was up 2.7% year over year, core CPI at 3.1%, still above the Fed's 2% target,
Still too high.
which means these higher for longer rate expectations, even with a potential cut looming, they still directly chip away at the present value of those distant future earnings for growth companies. And we also saw that market rotation you mentioned earlier, Powell hinting at maybe easing policy didn't lift all tech boats. Instead, money flowed into those interest rate sensitive cyclical and value sectors, consumer discretionary, industrials, real estate. They led the way.
So software kind of got left behind in that shift.
It found itself on the wrong side of that capital rotation, exactly. Investors were looking for opportunities less tied to those long-term growth stories in that specific moment.
Okay, so it's not just where the money's going, but why it's leaving software. Now, let's shift from the big picture down to the industry itself. Because your sources say there are also fundamental shifts happening within software that are adding pressure. Valuations, for one. We touched on this. For years, software companies traded at this huge premium compared to the rest of the market. But that's getting harder to justify now, right? Especially with interest rates normalizing.
Much harder. Those days of near-zero rates really flattered growth stock valuations.
And the numbers are pretty stark. That IGV ETF, its trailing price to earnings ratio, the PE, was as high as 52.9 at one point.
Which is huge.
Yeah. Compare that to the S&P 500's forward PE of around 23, maybe 19, 20 historically. And the price to sales ratio, PS for IGV, 9.86. Nearly double the tech category average of around 6.
It just shows how much optimism, how much future growth was baked into those prices.
For every dollar of revenue or earnings, investors were paying a massive premium. And you're saying this isn't just public markets, private deals too.
That's right. The froth we saw in 2021, those really high multiples in private software M&A, that subsided too. Things have stabilized back towards a more historically normal range, maybe 4 or 5 times total revenue. It's a broad reset.
A reality check, maybe?
You could say that. And what's emerged as a really critical factor alongside this is how enterprise IT budgets are changing shape right now. Your sources call it an uncertainty pause. Gartner, the big tech research firm, they found that CIOs, chief information officers, are being cautious about signing off on net new software spending.
Okay, why?
Well, after the big push on digital transformation, many companies are now taking a step back. They're looking harder at the ROI, the return on investment for new stuff, and they're also dealing with what your sources call organizational debt.
Organizational debt, what's that?
It's like the technical or process clutter left over from past decisions, stuff that wasn't quite right. Systems that don't talk to each other well, inefficiencies that built up, they need to sort that out now.
Cleaning house.
Exactly. And that means longer sales cycles for software vendors, more scrutiny on new deals.
Okay, so they're pausing on some new software.
But here's the flip side. This pause is happening at the exact same time as this massive surge in spending on the foundational infrastructure for AI.
The AI gold rush.
Precisely. Gartner forecasts enterprise spending on data center hardware, the servers, the chips, the networking gear, to spike by an incredible 40% in 2025.
20%, wow.
Yeah. You see companies like Oracle more than doubling their capital spending to build out AI-ready data centers. They need massive compute power for generative AI. So if we connect this to the bigger picture, it's almost like a zero-sum game for IT budgets in the short term.
Meaning money for one thing means less for another.
Exactly. Capital that might have gone to a new CRM system or an ERP upgrade is now being funneled into the picks and shovels needed for the AI revolution, the basic hardware and infrastructure.
Got it. Build the foundation first.
Right. And the market focus is shifting, too. It's moving from valuing just the promise of AI to demanding actual, tangible proof that companies can make money from AI features.
Showing the money, basically.
Pretty much. And this creates what we call a temporal mismatch, a timing issue. Software vendors might have cool AI features ready to sell, but customers are busy buying the hardware first. Their budgets are tied up there for now.
So it's like everyone's rushing out to buy the best diggers in concrete for their new AI building, but they haven't budgeted for the actual furniture and paint yet, which is where the traditional software vendors sit.
That's a pretty good analogy, actually.
And these broad pressures, they aren't just abstract concepts. They're really showing up in the financial reports of the big software names, right? Your sources point to this consistent pattern. The headline results, maybe the revenue and profit, they often meet or even beat expectations.
Hmm.
But it's the underlying metrics, the details, and especially the forward guidance that's causing investors to worry.
Exactly. Look at Microsoft, for example. Strong Q2 overall. Microsoft Cloud revenue over $40 billion, up 21% year over year. Their AI business. Over $13 billion annual run rate, up a huge 175% year over year. Looks great on the surface.
Amazing, but
But dig a little deeper. Azure Cloud growth, while still strong at 31%, actually decelerated and came in at the lower end of what they'd guided for.
okay, a slight miss on expectations there.
Right. And their more traditional businesses showed some weakness. On-premise server products were down 1% year over year. Gaming revenue was down 7%. This sort of unevenness across the different parts of the business, it raised questions.
About how sustainable the overall growth is.
Precisely. So the stock reaction was kind of muted despite those big headline numbers. Investors were looking at the cracks.
Okay, what about others? Adobe?
Similar story in a way. Adobe had record Q2 revenue, $5.87 billion, up 11% year over year. They even raised their full-year outlook, and they highlighted strong adoption of their AI tools like Firefly subscriptions nearly doubling.
Again, sounds pretty good. So what was the catch?
The catch was profitability. Investor skepticism lingered because Adobe guided for flat operating margins for the full year, and even projected a decline in margins for Q2.
Ah, so making less profit on each dollar of sales.
Potentially, yes. Concerns about the cost of investing heavily in AI while maintaining margins. Plus, this is key, they saw a sequential decline in total remaining performance obligations, or RPO.
RPO, that's like their backlog of future contracted revenue.
Exactly. And a decline there, along with lower new bookings, that's seen as a potential signal of a slowdown ahead. Investors got nervous about future growth.
I see. And Salesforce, they're a big bellwether too.
Salesforce, yes. Their Q1 results for fiscal 26 actually beat estimates. They were pushing their new Agentforce AI platform hard.
But the stock fell after the report.
It did. Why? Well, investors focused on slowing growth in their core cloud businesses, and crucially, a softer-than-expected outlook for current remaining performance obligations, or CRPO.
TRPO, that's the near-term future revenue indicator.
That's right. It's the RPO expected to be recognized as revenue in the next 12 months. So a soft outlook there is a direct hit to new-term expectations. And their overall revenue growth guidance, just 6-7% year over year, that was seen as a major disappointment for a company like Salesforce.
Only 6-7%. Yeah, that's way down from their historical growth.
Absolutely. So this collective experience, what does it tell us? It tells us the bar for what counts as a good quarter for software companies has been raised significantly.
No room for error anymore.
Pretty much. The market's patience seems thin. It's demanding profitable, durable, and predictable growth. And it's punishing even the slightest hint of imperfection, any sign of slowing momentum. The standards are just much higher now.
Wow. Okay, it really is a complex web, isn't it?
Yeah.
But bringing all these threads together, the macro picture, the valuations, the AI budget shift, the earnings, your sources paint this really holistic view of what's driving the pullback. You can almost see the chain reaction. Fed signals economic fragility, triggers market rotation, hits already stretched software valuations just as IT budgets are getting reallocated for AI infrastructure. And boom, it shows up in those bellwether earnings reports. It's all connected.
It really is a multi-layered story.
So with all these forces swirling around, the obvious question is, what happens next? Where do we go from here?
Well, looking ahead, there are a few potential catalysts that could help spark a recovery for the sector.
Okay, like what?
First, actual monetary policy easing. If the Fed definitively starts cutting rates, that provides direct valuation support for these long-duration software stocks. Makes their future earnings look better today.
Right, take some pressure off.
Second, and maybe even more important, demonstrable AI monetization. We need to see clear proof in upcoming earnings reports. Things like revenue growth reaccelerating, margins expanding again, strong CRPO growth. And critically, companies need to explicitly link that improvement to their new AI features selling well.
So proof the AI bets are paying off.
Exactly. And third, possibly the completion of the infrastructure build-out. Once companies have bought all the AI picks and shovels, maybe those IT budgets start shifting back towards the application software layer again. That could fill this current air pocket, as some call it.
Right, once the foundation is built, they can start decorating again.
Kind of. But there are also significant risks that could keep software underperforming for longer.
Such as?
Well, an economic hard landing, A full-blown recession would obviously lead to deep, broad cuts in IT spending across the board. That would hit everyone.
Yeah, that's the big fear.
Also, stubborn inflation. If inflation doesn't cooperate and forces the Fed to delay cuts or even reverse course, that keeps the pressure on valuations.
Higher for longer really bites.
It does. And finally, something maybe less talked about: increased regulatory scrutiny. There are new mandates coming, like CISA's 2025 Software Bill of Materials requirement. That could increase compliance costs and complexity for software vendors, potentially squeezing margins.
More hurdles to jump.
Yeah. So if we connect this all back to the bigger picture, for you observing these dynamics, what does it mean? I think the key is to view this pullback as a healthy, albeit painful, correction, not necessarily the start of some long-term decline for software.
So the fundamentals are still okay long term.
The long-term growth drivers, digital transformation, cloud, AI itself, they're still very much intact. The strategic imperative now, both for companies and investors looking at them, is probably to shift focus. Move away from maybe the hyper-growth, cash-burning companies that thrived in the zero-interest rate world,
Huh.
and look instead for high-quality, profitable software businesses. Companies with strong balance sheets, real competitive advantages, high customer retention, what they call net revenue retention, and crucially, a clear, demonstrable path to actually monetizing AI.
Quality over just growth at any cost.
Exactly. And this current market repricing, the sell-off, it might actually be creating some attractive long-term entry points into some of these best-of-breed companies that maybe got unfairly punished along with everyone else.
Interesting. So to quickly recap then,
Yeah.
the software pullback is definitely multi-layered. You've got the macro shifts, the valuation reset happening inside the sector, and this really critical AI-driven budget shuffle going on.
Mm-hmm.
But as you said, the long-term potential for software driven by these big trends, that remains incredibly strong. So what does this all mean for you as you watch the tech landscape unfold and think about where things might be headed next?
Well, maybe this raises an important question for you to ponder. Given this temporary air pocket we discussed, created by everyone rushing to build AI infrastructure, what kinds of innovative new software applications might actually emerge once enterprises finally shift those budgets back towards the application layer? How might that next wave fundamentally reshape the industries we know today? That could be where the next really exciting disruption comes from. Thank you for tuning us on this deep dive today as we explored these complex but really vital topics shaping the tech world.